When we picture building monumental wealth or like a wildly successful career taking off, we usually imagine this chaotic, high energy movie montage.
Oh, absolutely. Like the Wall Street traders shouting across a floor.
Right, with screens flashing red and green everywhere. Or some exhausted startup founder writing complex algorithms on a glass whiteboard at 3 in the morning.
Yeah, it's this visual shorthand we have for success.
Yeah.
We inherently equate intense motion with forward momentum.
We really do. We are deeply conditioned to expect progress to look like aggressive action, but then you look at the absolute titans of capital allocation.
The people who actually win the game at the highest possible level.
Exactly. And suddenly that high-octane movie montage just completely stops. When we look at their landscape, the ultimate secret to their monumental success is quite literally described as watching paint dry.
Which is the absolute antithesis of what our dopamine-driven, hyper-connected brains expect. I mean, doing nothing feels incredibly counterintuitive.
It really does. So today, we are exploring a profoundly fascinating set of principles. You might call them the 10 Commandments of investing.
And these are drawn directly from Monesh Pabrai, right?
Yeah, exactly. Monesh Pabrai, who is a billionaire investor and a very close disciple of the legendary Warren Buffett and the late Charlie Munger.
Such an incredible group of thinkers.
Unbelievable thinkers. But here is the real secret we are unpacking today. These are not just rules for picking stocks.
Right, they're so much bigger than that.
They really are. They are actually robust frameworks for living a deeply fulfilling, highly effective life, completely disguised as financial advice. We're going to extract these mental models and show you how to apply them to your daily decisions, your career, and your own personal growth.
It's going to be a fun one.
Definitely. And before we jump in, a quick note. To access more advanced researches, applications, and our latest published personal intelligent multi-agent deep value intelligence, welcome to explore and join deepvalues.ai community.
It's a great resource.
Also, to track total market temperature, welcome to search and download iOS app Buffett Indicator from Apple App Store.
Highly recommend checking that out.
And just a quick disclaimer, all analysis is based on publicly available sources and may be subject to revisions or differing interpretations. All contents from this channel is for information and research purposes only and does not constitute investment advice.
Right. Conduct your own due diligence before making investment decisions.
Exactly. And if you like to access wider topics, including life and investing philosophy, please subscribe to our sister channel, Deep Values. Don't forget to like this video. Much appreciated.
Awesome.
Okay, let's unpack this, starting with the biggest myth of all, the myth of the active genius. Pabrai points out this staggering statistic. He says less than 1% of Americans who actively pick stocks are actually good at it.
Less than 1%. That number really just stops you in your tracks.
It's wild.
And it becomes even more profound when you realize that the completely passive alternative, just putting your money into a broad index fund like the S&P 500, beats over 90% of those highly educated active stock pickers over a 20-year period.
Yeah, and Pabrai actually jokes that index investing takes absolutely zero brain cells, yet it practically guarantees a top-tier outcome over a lifetime.
Which is so funny, but so true.
So we have to look at the mechanics of why that happens.
Yeah.
The core mistake that smart, capable people make isn't a lack of intellect. It is a total lack of patience, coupled with friction.
What's fascinating here is the psychological and structural hurdle. Let's break down the mechanics of that.
Yeah, let's do it.
When you actively trade, you introduce friction. Fees, taxes, transaction costs.
Right, it eats into everything.
Exactly. But more importantly, you introduce human emotional bias. You panic when the market drops, so you sell low.
Yeah.
You get euphoric when it peaks, so you buy high.
The classic trap. Right. An index fund beats the active genius because it entirely removes the human ego from the equation. It simply captures the overall growth of human productivity, reinvests the dividends, and just lets the mathematical magic of compounding work uninterrupted over decades.
And doing nothing while that compounding happens is literally physically and mentally painful for high achievers.
Oh, absolutely painful.
Pabrai says the game of wealth is essentially transferring money from the active to the inactive.
That is such a great way to phrase it.
Right. If you have the temperament for it, turning page after page of a dense manual looking for one single good idea is thrilling. But most people just can't stand the boredom. They have this overwhelming urge to tinker.
To explain that tinkering urge, Pabrai relies on a very visceral mental model. He calls it, and this is great, the mistress is always hotter than the wife.
It is such a brilliant way to describe human bias. The wife, in this analogy, represents what you already own.
Right, the business you know inside and out, or the stock you currently hold, or even the career you are currently in. Because you are so intimately familiar with it, you see all of its flawless nuances, sure, but you also see every single minor annoyance and flaw.
Every little crack in the ceiling.
Exactly. The mistress, on the other hand, is the exciting unknown opportunity you don't own yet. We naturally undervalue the deeply familiar because it feels mundane.
And we massively overvalue the exciting unknown simply because it looks shiny from a distance.
We project absolute perfection onto the unknown.
We assume the grass is greener, but when you actually abandon your current position and get close to that shiny new opportunity, you inevitably discover it has its own unique set of deeply flawed realities.
Yeah, think about your own life for a second. Think about modern swipe culture or the endless FOMO we experience in our
Oh,
careers.
FOMO is huge here.
You're at a perfectly good job, you know the ropes, you're respected, but then you see someone on LinkedIn posting about their flashy new crypto startup.
Or some AI venture, yeah.
Right. And suddenly your perfectly good job feels stagnant. You want to jump ship. Why is the human brain so aggressively wired to equate action with progress, even when staying put is mathematically better?
Well, because for most of human evolutionary history, action was the primary mechanism that kept us alive.
Like literally staying alive.
Yeah, foraging, hunting, relocating when resources dried up, those were survival imperatives. Sitting still meant starving.
So sitting still was a death sentence.
Exactly. But in modern complex systems, whether we are talking about building generational wealth or cultivating long-term career growth, compounding is what yields the massive results.
And compounding requires uninterrupted time.
Right. Having a very high psychological bar for action creates a massive, almost unfair advantage. It forces you to become completely comfortable passing on mediocre opportunities and just sitting quietly with what already works.
So if temperament means doing absolutely nothing most of the time, how do we know what to do when an opportunity actually clears that high bar?
That's the million-dollar question.
When it is finally time to act, what is the play? Pabrai's next commandment is blunt. He says, you do not try to be original. You do not reinvent the wheel. You clone.
Cloning is perhaps one of the most powerful yet bizarrely underutilized tools in the modern business landscape.
I mean, take Sam Walton, the legendary founder of Walmart, for example.
Oh, he's the perfect case study.
Walton openly, almost proudly, admitted that Walmart was not an original idea. He cloned his core retail model from Kmart.
And didn't he do the same thing with Sam's Club?
Yeah.
Oh.
When he launched Sam's Club, he cloned that concept directly from Price Club, which was the predecessor to Costco.
Walton was famously obsessed with competitor research, but he did it with a very specific lens. He wasn't looking to validate his own genius.
Right.
He was looking for mechanics to steal.
Exactly. There's this famous story where he would go on family vacations, suddenly pull the car over, and drag his executives into a poorly run, incredibly messy competitor store.
Just walk right into the mess.
Yeah. His managers would walk out disgusted, saying, Sam, that place is an absolute disaster. And Walton would reply, yes, but did you see their candle display? The candle display was fantastic.
He was completely willing to step into a chaotic mess, entirely strip away his judgment, just to clone one golden nugget of operational brilliance.
It's amazing. And you see this exact same principle operating at the very highest levels of innovation today. Let's look at Elon Musk.
Oh, this is such a good example.
Musk uses something he calls the idiot index.
The idiot index. I love that name.
Right. When he's manufacturing parts for SpaceX or Tesla, it's brilliantly simple. He calculates the cost of the raw materials, like the base aluminum, titanium, or steel on the London Metals Exchange.
Okay.
Then he looks at the final price a supplier is trying to charge him for the finished part. If the raw materials cost, say, $300, but the finished part is $5,000.
That ratio is incredibly high.
Exactly. The idiot index is high. It means the supplier's manufacturing process is ridiculously inefficient. So Musk just says, fine, we will build it ourselves in-house and eliminate the gap.
What's fascinating here is not just the mathematics of the idiot index, but the industry's reaction to it.
Yes, because Musk's strategy is entirely public knowledge.
He literally published a biography detailing exactly how this works.
Legacy automakers know precisely the mechanics of how he's beating them on margins, but they completely refuse to copy it.
Which is wild. And it's not just billionaires doing this, by the way.
Oh, right, the podcast example.
Yeah, the hosts of the My First Million podcast use this exact cloning framework to build a massive business.
Tell them the story. It's so good.
So they went to a niche agricultural convention and saw a guy making a killing with a daily newsletter for farmers.
For farmers, like tractors and corn.
Exactly. It was a specific mix of half memes and half serious crop news. They didn't copy his content. They extracted the underlying mechanics.
They cloned the structure.
Yeah. They cloned the tone, the formatting, the daily cadence, and transplanted it into the crypto industry. They called it Milk Road, built an engaged audience in less than a year, and sold it for millions.
They completely bypassed the entire trial and error phase of building a media company. It is the ultimate shortcut.
It really is.
But I have to push back here. If cloning is so ridiculously effective and the blueprints are just lying around in plain sight, why isn't everyone doing it?
Right, it seems so obvious.
It sounds like having the answer key to a final exam sitting right on your desk, but stubbornly refusing to look down at it.
This raises an important question about the deepest layers of human psychology, specifically our relationship with ego.
Ego ruins everything, doesn't it?
It really does. Humans are generally terrible at cloning because we desperately want credit for being original. We want society to see us as the unique genius who birthed a novel idea from scratch.
Think about those legacy automakers.
Exactly. They have a century of institutional pride and deeply entrenched bureaucratic culture. They simply do not want to admit that a software guy from Silicon Valley has fundamentally engineered a better manufacturing model than they have.
Removing your ego entirely, just so you can shamelessly copy what definitively works, is a staggeringly rare superpower.
It's so rare.
Okay, so we sit still, we wait patiently, and when we see the mechanics of something working, we drop our ego and we clone it. But that presents a new problem.
Finding what to clone.
Right. How do you find the best things to clone? You can't just sit in your living room staring at the wall. You have to actively architect serendipity. You have to introduce randomness into your life.
Randomness is the essential fuel for discovering the anomalies that are actually worth cloning.
Pabrai's entire life trajectory is a testament to this. Back in 1994, he was just an IT engineer running a tech company.
He had absolutely zero interest in finance.
None at all. He happens to be at Heathrow Airport, flight delayed, and he completely randomly picks up a book by Peter Lynch, the legendary mutual fund manager.
Just out of boredom, basically.
Yeah. That one random choice opens a door. He reads it, gets fascinated, which leads him to read about Warren Buffett. That leads him to travel to Omaha for a shareholder meeting, which eventually lands him right inside Charlie Munger's elite inner circle.
Munger had a brilliant framework for this kind of compounding success. He called it the Lollapalooza effect.
Oh, break down the mechanics of the Lollapalooza effect for us, because it's not just simple addition, right?
Exactly. It's not 1 + 1 = 2. The Lollapalooza effect occurs when multiple independent behavioral biases or mental models all operate in the exact same direction at the exact same time.
Okay.
When they align, they don't just add up. They create a critical mass, like a non-linear explosion of results.
So they multiply each other.
Basically, yeah. So if you stack the willingness to introduce randomness like picking up a book in an entirely new field with the absolute lack of ego required to clone the strategies in that book,
And you combine that with the immense patience to let the strategy compound.
boom, 1 + 1 = 11.
I love that. And speaking of randomness, there is this hilarious story about Pabrai meeting Ed Thorpe.
Oh my gosh, this story's amazing.
For context, Ed Thorpe is a legendary mathematician who literally figured out the mathematics to beat the casinos at blackjack, wrote a book about it, and then took his formulas to Wall Street to beat the stock market.
The guy's a genius.
Absolute titan of finance. So Pabrai happens to be at a racquetball club, walks into the locker room, and practically bumps into Ed Thorpe. And they are both completely naked.
Of course they are.
And instead of awkwardly looking away, Pabrai realizes who he is, strikes up a conversation right there, and it leads to a decades-long friendship.
It's the ultimate chaotic, serendipitous encounter, but it illustrates a profound point about being open to the moment.
Here's where it gets really interesting, though. Randomness, by its very nature, feels dangerous. It feels risky and unfocused.
Yeah, it can just look like chaos.
Right. For you, listening right now, trying to optimize your time, how do you distinguish between introducing good randomness into your life and just letting yourself get derailed by chaotic distractions?
That is the crucial distinction, and the key lies in your environment. Randomness only works favorably when it is paired with proximity to greatness.
Proximity to greatness.
Yeah, Buffett always says, hang out with people better than you, and you cannot help but improve. If you introduce randomness by striking up conversations in a random dive bar at 2 a.m., you are going to get one very specific set of outcomes.
Probably not the outcomes you want.
Probably not. But if you introduce randomness by flying to the Berkshire Hathaway annual meeting in Omaha, the environment naturally filters the chaos.
I see.
The two strangers sitting next to you on that flight are already pre-filtered. They are statistically highly likely to be above average, deeply curious, and successful humans.
So randomness is the catalyst, yes,
Yeah.
but the quality of the environment you actively place yourself in acts as the filter. That makes perfect sense. So let's connect the dots. You've architected serendipity, You're in a high-quality environment, and a seemingly golden opportunity lands in your lap. Now you have to evaluate it without getting overwhelmed.
Which is where a lot of people freeze up.
Right. This brings us to Pabrai's commandment on simplicity, which he calls the anti-spreadsheet rule.
Thou shalt not use Excel. It is a profoundly liberating concept.
He argues that if you cannot explain the fundamental thesis of an investment or a new business project to a 10-year-old in 4 simple sentences, you must put it in the too hard pile.
Buffett actually keeps a physical tray on his desk, literally labeled too hard. And he has said it is the most frequently used tray in his office.
That is so telling. Let's look at the historical example of the American Express salad oil crisis to see how this works in practice.
Oh yeah, that is a classic.
Back in the 1960s, American Express had a subsidiary lending division. They made a massive loan to a commodities trader, financing his huge inventory of salad oil.
But it turned out the trader was a massive fraudster.
A total scam artist. He had filled the giant vats mostly with seawater, with just a thin layer of oil floating on top to fool the inspectors.
Just enough to look real from the top.
Right. When the fraud was exposed, American Express took a catastrophic financial hit, and their stock plummeted overnight.
Wall Street completely panicked. Analysts were firing up their complex models, projecting institutional contagion.
They assumed the whole company was going under.
They assumed the loan default would fundamentally destroy the entire American Express ecosystem.
But Buffett didn't build a complex spreadsheet to predict the fallout. He relied on ruthless simplicity. He did what they call shoe leather research.
Which just means hitting the streets, right?
Exactly. He literally walked out of his office, went to local Omaha steakhouses, and just stood by the cash registers. He wanted to observe one very simple fundamental mechanic. Did consumers still trust the American Express brand?
Were they still using the card?
Right. Were they still pulling out the card to pay for dinner? And were the restaurant owners still happily accepting it? And they were. Absolutely nothing had changed at the cash register.
Which revealed a crucial insight about the company's moat.
Yes. For those unfamiliar, an economic moat is that invisible barrier, like a castle's moat, that protects a business's core profitability from competitors, or in this case, from isolated corporate scandals.
The credit card business was the real moat.
Buffett saw that the consumer credit card division was completely insulated from the fraudulent lending division. Because he stripped away the macroeconomic noise and just watched human behavior, he poured 40% of his entire fund into the discounted stock and made an absolute fortune.
If we connect this to the bigger picture, Pabrai applies this exact same ruthless simplicity today. There was a period recently when the Turkish lira was experiencing a catastrophic collapse, losing something like 90% of its value.
Wow, 90%.
Yeah, and Pabrai used that macroeconomic terror to heavily invest in warehouse operators in Turkey.
Which sounds insane on the surface. Most Wall Street analysts would look at a 90% currency collapse, assume the country is uninvestable, and run for the hills.
Because those analysts are entirely focused on complex, shifting macroeconomic currency projections. Pabrai completely ignored the currency and looked at the physical mechanics.
What's the physical mechanic of a warehouse?
Well, what actually is a prime logistics warehouse? It is land, it is paint, it is cement, and it is steel. Those are physical assets that are inherently inflation-proof. To explain this, he uses what he calls the thermonuclear event analogy.
I love this analogy so much.
Go for it, explain it.
He says, imagine a global thermonuclear war happens tomorrow. 99% of humanity is completely wiped out. All global fiat currencies instantly evaporate into meaninglessness.
A total apocalypse scenario.
Right. Even in that extreme post-apocalyptic reality, the surviving humans will still be perfectly willing to trade 15 minutes of their hard physical labor for an ice-cold Coca-Cola.
It's so true.
The fundamental value exchange doesn't rely on the existence of the US dollar or the Turkish lira. It relies entirely on a permanent, unchanging human desire. The warehouse, like the Coca-Cola, holds intrinsic value regardless of the spreadsheet math.
That is just such a clear way to see the world.
But let me challenge this philosophy for a second.
Okay.
We live in a highly complex era. We are surrounded by artificial intelligence, machine learning, high-frequency trading algorithms. Isn't there a massive danger in oversimplifying our reality? Can we genuinely rely on a 10-year-old's understanding of a business to navigate today's economy?
It is a valid concern, I hear you. But complexity is very often a disguise for uncertainty.
How so?
The people selling you the most complex models are usually the ones who benefit from your confusion. The most enduring, cash-generating businesses in the world rarely rely on shifting algorithmic complexity.
Give me an example.
Take Constellation Software, for instance. They simply buy up tiny, incredibly boring software companies that run essential, niche functions like software for municipal transit authorities or golf course management.
Very boring stuff.
Super boring. Or consider a company that operates a prime international airport. These businesses are natural monopolies. The peripheral technology around them might evolve, but the fundamental mechanics, the human need to physically travel, the necessity of basic operational infrastructure, those remain entirely static.
So the core of the business doesn't change.
Exactly. If you require a 50-tab Excel spreadsheet to prove a project is viable, the core idea probably lacks the foundational strength to survive reality.
So if stripping away complexity protects our money and our investments, how do we apply that same ruthless simplicity to protecting our time?
Oh, this is the best part.
Because that perfectly bridges us from how to allocate capital to how we allocate our most finite, non-renewable resource, our limited time on Earth.
This is where Pabrai's insights elevate from mere financial strategy to deeply profound life philosophy.
He introduces what Buffett considers his single most important framework for life, the inner versus the outer scorecard.
Such a powerful thought experiment.
The way Buffett frames this thought experiment is brilliant. He asks, would you rather be the world's greatest lover, but secretly known to everyone else in the world as the absolute worst?
Okay.
Or would you rather be the worst lover in the world, but celebrated publicly by everyone as the greatest?
It immediately forces you to identify the mechanics of your own validation. Where is your psychological anchor?
Right.
Are you driven by external metrics, the outer scorecard? That's agonizing over what your peers think of you, obsessing over your LinkedIn title, your status symbols.
Which so many people do.
Oh, constantly.
Huh.
Or are you driven by internal metrics, the inner scorecard? That is measuring yourself against your own standards of excellence, your own integrity, regardless of applause.
To hammer this home, Pabrai brings up that famous Ben Franklin quote, many people die at 25 and are buried at 75.
That quote always gives me chills.
It's haunting. They get a stable job, they figure out how to satisfy the outer scorecard, and then they completely stop growing. They stop taking risks because they are terrified of looking foolish to their peers.
Contrast that paralyzed existence with Charlie Munger. Munger was actively researching and deploying capital into long-term investments just 6 days before he passed away at 99.9 years old.
6 days before he died.
Yeah, he was living entirely by his inner scorecard, making intellectual bets as if he had another lifetime ahead of him, completely unbothered by the reality of his own mortality.
This touches on industrial psychology, actually. Pabrai suggests that our true calling, our innate psychological preferences and talents, are largely baked into our hardware by age 5.
Really, by age 5.
Yeah. The ultimate goal of human existence is to live what he calls an aligned life. It's doing the hard work to figure out what those innate traits actually are so you can finally get the unique music that is inside you out into the world.
So what does this all actually mean for us? How do we practically apply this?
Well, during the interview, one of the hosts admitted to doing something that honestly felt a bit jolting. Based on this discussion about mortality and time, he actually went online and Googled an actuarial calculator to find his exact statistical death date. Whoa. Yeah. And it spit back a specific day, September 28th, 2075. He admitted it totally freaked him out. And I have to agree, actively contemplating your exact expiration date feels incredibly morbid.
It definitely feels morbid if you view it purely through a lens of anxiety. But Pabrai reframes the mechanic entirely. It isn't morbid, it is intensely, ruthlessly clarifying.
Clarifying, I like that.
He quotes Gandhi, "Live as if you were to die tomorrow. Learn as if you were to live forever." When you internalize that you only have until 2075 or whenever your specific date is, it forcibly strips away the delusion that you have an infinite amount of time. It cures the desire to endlessly postpone your actual life.
He calls out that classic trap we all fall into. I'll just work 3 more years at this miserable corporate job so I can build my resume. Then I'll save up a bit more, and then someday I'll finally start the project I actually care about.
Buffett famously compares that specific kind of delayed gratification to saving up sex for old age.
Which is just a great visual.
It simply defies logic. True alignment means you stop postponing your passions for some hypothetical perfect future date that the universe has in no way guaranteed you.
Think about your own schedule for the next week. Look at the meetings you are dreading, the projects you are stressing over, the evenings you are sacrificing. Are those commitments genuinely serving your inner scorecard?
Or are you just exhausting yourself trying to maintain an image for people who aren't really paying attention anyway?
Exactly. Are you letting your unique music play, or are you keeping it locked away for a someday that might never arrive?
Transitioning from an outer to an inner scorecard requires immense courage, especially because society is constantly incentivizing you to conform.
Always pushing the outer scorecard.
Right. But as every story we've analyzed today illustrates, from Sam Walton standing in a messy Kmart to Buffett ignoring Wall Street panic in Omaha, the absolute greatest returns, both financially and spiritually, come from being fiercely, unapologetically aligned with your own internal truth.
Let's bring all of this together because we've covered a massive amount of ground today.
We really have.
We started with the immense counterintuitive power of cultivating patience, developing this psychological fortitude to literally watch the paint dry while everyone else is furiously trading and panicking.
Which is so hard to do.
We talked about dropping our ego completely so we can aggressively clone the underlying mechanics of what definitively works.
We explored how to strategically inject serendipity into our routines by seeking proximity to greatness, allowing that Lollapalooza effect to take hold.
And we discussed the absolute necessity of demanding ruthless simplicity. If you can't explain it to a 10-year-old, or if it requires a massive spreadsheet to justify, it goes straight into the too hard pile.
And ultimately, all of those frameworks lead to one destination: living an aligned life driven entirely by an inner scorecard so you don't end up dying at 25 only to be physically buried at 75.
This raises an important point about the beauty of studying these mental models.
Yeah, the pursuit of wisdom is one of the very few games in life where you genuinely only get better as you age.
That's a great point.
An athlete's physical mechanics will peak in their 20s, but an investor, a thinker, someone actively cultivating an inner scorecard, they just keep compounding pattern recognition. Every single year, their latticework of knowledge grows infinitely stronger.
I love that perspective. Now, before we wrap up today, I want to leave you with one final provocative thought to chew on.
Let's hear it.
We talked extensively about getting that unique music out of you rather than keeping it locked away while you chase an outer scorecard. But think about the mechanics of this. If your unique talents, your ideas, your true music is locked inside you right now because you are too busy maintaining a certain professional image or working a grind you merely tolerate just for the prestige, who is actually benefiting from your silence?
That is.
Seriously, is your daily exhaustion just funding someone else's inner scorecard?
That is the ultimate hidden cost of misalignment.
It really is. Thank you for joining us on this deep dive into these incredible frameworks. We hope you carry these mental models with you into your decisions this week. Take a hard look at your life, find the areas where you need to drop your ego, introduce a little high-quality randomness, and remember, sometimes the most profitable, profound thing you can possibly do is just pull up a chair and calmly watch the paint dry.